Okay, so ready for a deep dive into like the OG of investing? Warren Buffett.
Oh, yeah. Buffett's the OG for sure.
We're diving into his 1986 letter to Berkshire Hathaway shareholders. Back when shoulder pads were like a thing.
Uh-huh. Yeah, those were the days. Big hair, bigger shoulder pads.
And the internet. Totally unheard of.
Wild, right.
Sure did.
But that's what's so cool about Buffett. His wisdom, it's timeless. Like, it still applies today.
Totally. Okay, picture this. You invest in a company in 64, right? By 86, your investment's grown like over 23% every year on average.
That's insane.
That's Berkshire Hathaway. It's almost like too good to be true, you know?
Yeah, that kind of performance, it definitely makes you pay attention when Buffett talks investing. These letters, they're not just like, here's what I bought. They give you a glimpse into how he thinks, you know?
It's like a cheat sheet for investors.
Exactly.
So before we go too far, there's this thing Buffett talks about, book value versus intrinsic business value. It's key to his whole strategy.
Right, because the balance sheet only tells you part of the story.
It's like looking at a company's, high school yearbook picture versus seeing them all grown up.
I like that analogy.
It gives you a snapshot of the past, but doesn't tell you their future potential, right?
Exactly. And Buffett's all about that potential. He wants to see beyond those numbers, understand the underlying business, the people, the competitive landscape.
He's like a detective looking for clues that everyone else missed.
And those clues often lead him to companies whose intrinsic value, their true worth, is way higher than their book value.
And don't forget, 86 was a wild ride economically. We had inflation going crazy. The stock market was booming.
Like a bull in a china shop.
It was a recipe for, well, who knows what.
Definitely interesting times.
So how does Buffett handle all this? In this letter, he talks about his two main jobs at Berkshire.
Okay, I'm all ears.
First, he says, you gotta have great managers. He actually compares it to managing a golf team. But not just any golf team. Imagine a team with, like, Jack Nicklaus and Arnold Palmer. You wouldn't tell them how to swing the club, right?
You just get out of their way.
Exactly. And that's pure Buffett. Find exceptional people you trust, then step back and let them shine.
It's about empowering your team, giving them the freedom to excel.
And this reminds me of that great anecdote he tells about the Catholic tailor describing the Pope.
Oh, I love that one. What was it again?
The tailor, he wasn't interested in discussing, theology or anything. He just said he's a 44 medium.
Uh-huh. So good.
And that's what Buffett looks for in managers. People who are masters of their craft. They know their stuff inside and out, just like that tailor knew his measurements.
The 44 mediums of their industries, right?
Exactly. Now, here's the brilliance of it. By bringing in these superstar managers who don't need to be micromanaged, what does that free up Buffett to do?
Focus on the big picture. Strategy.
He gets to spend his time on what he does best, finding those incredible companies to invest in, allocating Berkshire's capital. And trust me, in 1986, that was no walk in the park. Berkshire was already a massive company. Finding investments that could actually move the needle. That's tough.
Yeah, it's like trying to find a needle in a haystack, made entirely of money.
Exactly. The bigger you get, the harder it is to find those game-changing opportunities. It's like trying to find parking for like a giant RV,
Right.
in a world where everyone's driving those tiny little smart cars.
Totally. And finding those parking spaces, that's where Buffett's approach to acquisitions comes in.
Right. And this part's kind of fun. He actually puts this like businesses wanted section in his annual letter.
It's so Buffett.
Right. It's classic. So there's this shareholder, Bob Heldman, and he reads this businesses wanted section and he's like, wait a minute. I know just the ticket.
This is how deals were done. Pre-internet, pre-everything.
Seriously.
Yeah.
Talk about old school. So Heldman writes to Buffett about this company, Fetchheimer Brothers. They make uniforms.
Uniforms. Not exactly the sexiest industry.
Nope, not at all. But here's the kicker. Buffett buys the company without even visiting the HQ.
See, he cares about the business itself, not like fancy offices or smooth-talking CEOs.
He's like, just show me the numbers.
Exactly.
Yeah.
Show him the books, the team, the long-term potential.
He's all about those long-term gains. And
Yeah.
he lays out his 6 big things he looks for in a business. Like, number 1, it's got to have demonstrated earning power.
Meaning,
Buffett doesn't care if you had like one good year. He wants to see consistent profits over time. None of that flash in the pan stuff.
he's playing the long game.
Yeah.
So consistent earnings, check. What else?
Okay, strong management. Remember those 44 mediums?
Oh, yeah. The folks who really know their stuff.
That's what he wants. People who are passionate about the business, not just like climbing the corporate ladder.
Passionate and competent.
Yeah.
Got it. What else is on Buffett's checklist?
He's really wary of companies swimming in debt. He likes a strong financial foundation, something that can weather a storm.
Makes sense, especially in '86.
Yeah.
The economy wasn't exactly a sure bet back then.
All right. He also wants to see good returns on equity. Basically, is the company using its resources wisely to make money?
Smart. Okay, so we've got solid earnings, strong management, low debt, good returns. What else are we looking for?
He wants businesses that are easy to understand, not some super complicated thing with a million moving parts.
Simple and straightforward. Makes sense.
Yeah, Buffett likes to be able to wrap his head around what a company actually does. And last but not least, he insists on paying a fair price.
He's not out there trying to cheat anyone.
Nope, he wants everyone to walk away feeling good about the deal. Which, I gotta say, that's not always the norm in the business world.
No, definitely not. So we've got Buffett's acquisition criteria down. Anything else interesting in this part of the letter?
Oh, one more thing. He mentions he's open to using Berkshire stock for the right acquisition. That got people talking.
I bet. What was the message there?
It showed he was willing to be flexible. If the right opportunity came along, he'd even give up a piece of Berkshire to get it.
Wow. So even though he's got these rules, he's not afraid to bend them a bit for a truly exceptional business.
Exactly. Okay, ready to switch gears a bit.
Sure. What's next?
Let's talk insurance. Not exactly the most thrilling topic, right?
Well, unless you're Warren Buffett, apparently.
He compares the insurance business to, get this, corn. It's all about supply and demand.
Okay, I'm intrigued. How so?
So when there are tons of insurance companies out there, prices drop like a bumper crop of corn.
Everyone's competing, so premiums go down. Makes sense.
But then, let's say there's a big natural disaster or a bunch of insurance companies lose a ton of money.
Suddenly, insurance is in high demand. Less supply, prices go up.
And that's where Buffett shines. He waits patiently for those moments when everyone else is freaking out. He's like, everybody panic. And Buffett's over there just chilling, scooping up deals.
Totally. He's got that long-term vision. He's not afraid to be greedy when others are fearful, just like he always says.
Right. And that's where this float thing comes in. It's a big part of how Berkshire makes its money.
Okay, float. Break that down for me.
So insurance companies, they get your premiums up front, but they don't pay out claims right away, right?
Right. There's a bit of a lag.
Exactly. That money, that's the float. It just sits there earning interest until it's needed for claims. It's like free money for Berkshire to play with.
Not exactly free, but I get your point.
Yeah.
It's like having this pool of money they can invest.
Exactly. And Buffett, he's not just going to let that money sit there doing nothing. He invests it carefully, of course. And that's how Berkshire really racks up those gains,
Makes sense. It's like a double whammy. Profits from the insurance business plus returns from those investments.
Yeah. And speaking of smart investments, we got to talk about Geico. Buffett, he loves this company. He talks about them a lot in this letter.
They're a big part of Berkshire's portfolio, right?
Oh, yeah. Big time. See, Geico, they have this really efficient business model, low operating costs. That means more profits, which means more float for Buffett to invest.
Like a beautiful cycle.
Totally. And it all comes back to those 44 mediums we were talking about. Remember, Buffett gives huge credit to Geico's management, specifically Bill Snyder and Lou Simpson.
He says they're the ones who really made it all happen, the brains behind the operation.
Exactly. It shows that finding the right people is just as important as finding the right business. Okay, but let's circle back to the stock market for a sec. Buffett, he gets pretty real in this letter about how unpredictable it can be, like trying to time the market. He thinks that's a fool's game.
Yeah, it's like trying to predict the weather, You can make educated guesses, but sometimes Mother Nature just does her own thing.
Totally. He says emotions drive the market, fear and greed, and that leads to some pretty irrational behavior.
So what's the solution? How do we avoid getting caught up in that emotional roller coaster?
Well, Buffett has this quote. He says, "Be fearful when others are greedy, and greedy only when others are fearful." Basically, go against the grain.
Easier said than done, right? Especially when everyone else seems to be making money hand over fist.
Oh, for sure. But that's what separates the long-term investors from the short-term gamblers, I guess. And this ties into another one of Buffett's big things, his till death do us part philosophy.
I'm guessing that's not about marriage counseling?
Nope. He's talking about finding great businesses and holding on to them no matter what the market's doing.
So not checking your portfolio every 5 minutes?
Nope. It's about tuning out that noise and trusting that in the long run, those great businesses will prevail.
It's like that saying, slow and steady wins the race. Right?
Exactly. But it takes discipline, patience, and a whole lot of faith in your picks. Which, let's be honest, not everyone has.
True that. So much of investing is psychological, isn't it?
It really is. So, as we wrap up our deep dive into Buffett's 1986 letter, think about this. What can we learn from all this? He emphasizes intrinsic value, long-term thinking, finding those passionate 44 medium managers. It's like a masterclass in investing, but on a smaller scale, can we apply these ideas to our own financial lives? It's something to think about, right?
Absolutely. This letter, it's a gold mine of wisdom. Thanks for breaking it down for us.
Anytime. Always a pleasure to geek out about Buffett. Until next time, happy investing, everyone.